I'm Yahoo Finance Executive Editor Brian Sozzi here, taking a look at a live shot of the opening bell on Wall Street on this Tuesday morning. EB Research Partnership ringing the bell at the NYSE. The Campbell's Company, formerly known as Campbell's Soup, getting things popping over there at the NASDAQ. Now the markets are marking time until they get their latest pound of flesh in the form of new catalysts. They had a small catalyst this morning and an earnings miss from home improvement giant Home Depot, though the retailer did reaffirm its sales and profit outlooks. Attention will now turn to earnings results out of Target and Walmart this week, and weekend with a closely watched speech by Fed Chair Jerome Powell on Friday at Jackson Hole. Now, opening bid is all about serving up investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with all that money I know you have in your portfolio. It's been a big year, so you should have that money. All right, let's head down to the NASDAQ in Times Square and check out Yahoo Finance senior reporter Brooke DePalma. Brooke, I can't believe it's been a year since Campbell took soup out of its name. I remember you down there covering that.
Certainly an exciting day. As soon as you walk in, there's tons of Campbell signage all around the NASDAQ, so definitely exciting on that note. And an exciting start to today's trading session. After a bit, we saw all three major indices border the flat line on Monday. We're getting similar, but a bit of an uptick, especially with the Dow as Home Depot pushes that indice higher. Taking a closer look at the two-day chart, what we're seeing in the early innings of today's trading session is the Dow leading gainers here up 0.2%. The NASDAQ down slightly, nearly 0.2% in today's trading session. And the S&P 500 also roughly flat here, just down about 0.06%. I also do want to take a look at the Russell 2000. That indice has been getting lots of attention, especially over the past few days. Month to date, that indice is up about 6% over the last 12 days, according to the YF Interactive. And that's largely after Bank of America's Savita Subramanian thinks that a shift to value and small cap stocks may be coming after we've seen the NASDAQ really gain momentum year to date, as many investors have gone to that AI tech risk-on trade environment. So let's keep a look on the Russell 2000. That's indice is up about 0.3% today, outperforming the Dow, NASDAQ, and the S&P 500. I do want to take a look at the heat map because there are a few key stocks that I'm keeping a close eye on today. One is Intel, and that's largely because of that soft bake investment that we've seen come out overnight. Intel leading momentum here for the NASDAQ, up about 6% as we kick off today's trading session. I know we'll talk more about that on opening bid. I also want to take a look at the Dow. What we're seeing there is Home Depot leading the gains here, up about 3% in this early market trading session. Also want to take a look at Walmart. They're also reporting out this week. That stock has been getting quite the attention year to date, up about 12%, as consumers really have doubled down on wanting low prices. But once again, a bit of a mixed picture here to start off today's trading session. All three major indices, mixed picture there. The NASDAQ down about 3%, S&P down nearly 2.2%, and the Dow in the green, holding on to the momentum.
Yeah, thanks so much, Brooke. I'm really surprised by that Home Depot move, but we'll talk more about it in a minute. All right, I'm kicking things off with your daily guide to the biggest market drivers of the trading day. Here's what I'm watching. Number one, the bull market breather. It may not feel this way, given the gains many investors are probably sitting on this year, but the markets haven't done much in the past week. In fact, the Dow Jones Industrial Average, NASDAQ Composite, and S&P 500 are flat over the stretch. So what's the deal? Is it a case of investors having no clue if the Fed chief, Jerome Powell, will signal a rate cut at Jackson Hole later this week, or is it the early signs of a pause in the bull market thanks to economic uncertainty? We'll discuss. Number two, fixing that broken down washing machine rather than buying a new one. Speaking of economic uncertainty, Home Depot is out with an earnings miss. The company's CFO downplayed the miss in a call I had with him this morning, pointing to sales strength late in the quarter and a reaffirmed outlook. But the red flags in the report were as clear as a nail sticking up through a piece of plywood on the ground. I'll share more from my chat and what could be in store for one of America's biggest retailers. And number three, sound the bubble alarm bell. OpenAI CEO Sam Altman had some loose lips at a reporter dinner and warned about an AI bubble not unlike the dot-com bust. The timing of the call is interesting, as OpenAI just raised $8.3 billion, valuing the ChatGPT maker at a cool $300 billion. We'll dive into whether investors should heed Altman's warning or ignore it as a billionaire just simply having a bad meal. On the opening bid roundtable, Peter Berezin, BCA Research Chief Global Strategist and Director of Research, Patrick Moorhead, More Insight Strategy and Founder and Chief Analyst, and Yahoo Finance Senior Reporter Brooke DePalma is here for the chat. Peter, I want to go over to you because I've been locked in on Home Depot really all morning long. A company was out there earning, I can't think of a better company, at least today, offering up more clues on the economic outlook than a Home Depot. Where do you stand on the S&P 500 this year? I know you and I have talked in the past, and you've been pretty bearish.
Yeah, I mean, I think Home Depot stock is up today because investors were worried that they would guide lower for the year. They didn't, but the earnings were not particularly good. And certainly the outlook for the housing market remains fairly weak. So we got housing starts today. They did increase, but building permits, which tend to lead housing starts, fell to a fresh lowest number since the pandemic. If you look at inventories of newly built homes, they're the highest since late 2009. Home prices, whether it be the Case-Shiller index or other indices, are falling. So this is not a good state for the housing market. And that's important because the housing market is a leading indicator for the economy. It's also a bellwether that tells us whether monetary policy is still tight. And the housing market is saying that it is, which means that the risks to economic growth are to the downside. And that in turn implies that the risks to stocks are to the downside.
Patrick, we're going to really dive into all things tech. Of course, I know that's very much in your wheelhouse. But is the reality that as long as this AI trade's working, the S&P 500 is likely to work?
It is for sure. And while Altman said that we are in a bubble, and by the way, bubbles aren't bad until they burst, they get a lot of investment going. I think the train keeps going, and I think it can support the S&P 500.
Peter, let me get back to you real quick. We've been thinking or looking at all morning long Sam Altman's comments that we may be in some form of AI bubble. Do you think that is investors should heed that warning and start to lighten the load on some of these stocks?
I think they should, and I think OpenAI is a good example of the AI bubble. You've got a company that is losing a lot of money on the hope that eventually they're going to be able to significantly raise prices and generate enough revenue to cover their capex costs. That might not happen. A lot of these AI models are similar. They use the same neural net transformer architecture. They're a bit like airlines in many respects. You've got a commoditized product with a huge amount of capex requirement. That's not a recipe for strong profitability or high equity returns.
Patrick, if there's anything that stood out to me from this latest tech earnings season, the demand has been strong. I talked to ServiceNow CEO Bill McDermott. That company blew it out of the water. Microsoft blew it out of the water. Alphabet. Anything that you're seeing in your research that would suggest a warning from Altman should be paid more attention to?
I think investors should squint at enterprise software tickers like Salesforce, Adobe, Workday, those that haven't seen the big boom in AI. And it's tough because all three of those businesses are going to be threatened by essentially horizontal agents that turn into vertical. They can do a lot of the magic tricks that what they're providing already. And I think you're seeing on all three of those tickers, we're seeing some weight on that.
Brooke, I mentioned Home Depot at the top of the show. You have been covering the company's earnings all morning long. Quarter didn't start good for this company.
Yeah, the reaction right now, stock up about 2% in the early hours trading here. And largely that's because, as you said, better than feared guidance that we got from the company where they reiterated for the full year, but also some commentary on the call definitely has investors excited as well. We know that in May, June, same-store sales growth in the U.S. was largely muted, but in July, they got a bit of a bump up. They saw a positive 3.3% same-store sales growth in the month of July. In addition to that, they said that consumers are really waiting for the right time to jump into this market. They said they're still doing these smaller discretionary projects and they're really waiting for this rate environment either for them to sort of get used to or see lower interest rates as well. We know that this is what in the past the executives have called their Super Bowl season with investing in the backyard. So they said that seasonal product categories, patio grills, and live goods, maybe chickens perhaps, also boded well well for them this quarter. And so there's a bit of momentum here and excitement that the back half of the year is what they expected. It's better than, as we ease comparisons from last year where they had a bit of a drop off. It's certainly holding up to that excitement that they had foreshadowed in the beginning of the year.
Brooke, Home Depot trying to muscle in on Tractor Supply selling live chickens. I mean, I live near the Bayshore Home Depot. I've never seen a chicken there walking around the parking lot.
Hey, they said live goods in the call. We got to look into it.
Fair enough. I'm glad. Let's just stay on Home Depot real quick because I caught up with CFO Richard McPhail. I asked him about interest rates, and he said consumers continue to hold back on buying large-scale purchases like appliances and doing bigger remodeling projects because rates remain high. And Peter, his commentary on the rate outlook, it didn't sound like if we were to get a 25 basis point rate cut, suddenly Home Depot's business magically reawakens, sales start to boom. It sounds like we might need a couple more rate hikes to at least open up a company like a Home Depot and perhaps justify some of the valuations we're seeing in this market.
Well, the problem is that what matters for the housing market is not the Fed funds rate. It's the longer-term bond yield. That's what dictates where mortgage rates go. And so if the Fed is perceived as cutting rates because of political pressure, that's not going to lead to lower long-term bond yields. It's going to lead to higher long-term bond yields because inflation expectations will go up. So I think the Trump administration should be careful what they wish for. If rates fall because of a recession, that's not going to be good for Home Depot. If rates fall because of political pressure, that pushes up longer-term bond yields. That's also not good for Home Depot. So I think the housing sector, it's cheap. So I'm not saying you should necessarily short these stocks, but the macroeconomic environment is not very favorable towards it.
Peter, what's that triggering point that starts the S&P 500 on your path to 5,700? And then what are you looking for? Why are you still at about 60% recession call?
Yeah, well, I think, large parts of the economy are sputtering. They're at stall speed. The labor market is clearly weakening. We saw that in the payroll data. We see that in the job openings data. The consumer sector is on its back foot. Retail sales are basically flat for the year. Real personal consumption expenditures, what the Fed looks at, they're flat on the year. We haven't had any consumer spending growth so far in 2025. The housing market, as I said, is in dire straits. Commercial real estate is struggling. The office vacancy rate just hit another all-time high in the second quarter. So this is an economy that I think is fundamentally weak. If we get some pull back in terms of AI capex, which I think is very, very possible, because if you look at the free cash flow of the hyperscalers, it's now trending lower. That would add another potential problem to the macroeconomic outlook.
Patrick, over to you real quick. Do you see that as possible, that AI capex slowdown that Peter's talking about? Think that happens this year, or is that a 2026 thing, if at all?
I think it's a 2026 thing, worst case. I think we're good at least for the next 18 months. And while we have to look at the downstream positive impacts of AI, right now, when you see Meta, you see Google, and you see even OpenAI driving downstream benefit from AI, that's a very positive sign. The first milestone you'll see that there might be some chinks in the armor here is going to be capex. And every quarter, right, all of the hyperscalers get on and talk about that. That would be the first, concrete indication that it's going to slow down. But the other part of it is there's two other areas that we haven't seen any growth in yet, and that's what I'd like to call enterprise AI, on-premises AI, and also the industrial edge with robotics. Those are longer pulls, but those are things we're not talking about yet related to AI because we haven't yet seen these green shoots that prove out the case.
Well, I'm glad you're here to help tee it up. All right, I'll be back with more from my opening bid roundtable coming up, and Intel finds itself on the hunt for cash. We'll be right back. Welcome back to Opening Bid. OpenAI CEO Sam Altman may be warning about an AI bubble, but apparently the semi team at Citi is looking beyond that memo. Citi analyst Chris Danley calling out that the Philadelphia Semiconductor Index is back at a record high, powered by earnings optimism from key tech companies. Danley is staying bullish on the stocks and thinks earnings from NVIDIA, Broadcom, and Micron will stay strong for the foreseeable future. Danley's top semiconductor pick is Microchip Technology, ticker MCHP on the Yahoo Finance platform. All right, let's fire up my stock of the day, and we're going to stay on tech. With chatter, the government is nearing taking a 10% stake in Intel. I guess one shouldn't be shocked. The bruised tech giant is hoping to gain some street cred on its future product roadmap by tapping SoftBank and Masayoshi Son for $2 billion. Embattled Intel CEO Lip-Bu Tan also gains a Trump friend in Masa. Son said in a statement he sees Intel playing a critical role in U.S. chip development. It's still something to see this unfolding in Intel, which has billions in cash and is in no means in a financial death spiral. Given Masa's close ties to the Trump administration, I suspect the government stake announcement could be next. As seen on the Yahoo Finance platform, SoftBank's $2 billion investment will make it about a 2% holder in Intel. That's good enough to be its fifth largest shareholder. Still with me is my roundtable, Peter Berezin, BCA Research Chief Global Strategist and Director of Research, Patrick Moorhead, More Insights and Strategy Founder, CEO and Chief Analyst, and Yahoo Finance Senior Reporter, Brooke DePalma. Patrick, I'm coming right to you here. Nothing is for free in this world. So it's not like the Trump administration is going to come here to Intel, oh, we just want a stake in your company, and then you could continue doing whatever the hell you want. What could some of the terms be if this deal were to come to fruition?
Yeah, so first of all, I don't think it's just going to be the U.S. government investing. I think it's going to be the U.S. government and then some of the potential customers that would be investors as well. And the alternative to that could be the stick, which is, hey, if you don't do business with Intel Foundry here in the U.S., I am actually going to do it this time. I'm going to put tariffs, or I'm going to charge you off the top if you want to pull these chips in from Taiwan or for Samsung. I don't think it's smart. I mean, with a 10% buy-in, right? You get a board seat. I don't think that is a positive thing long term. There were some decent things that were done with U.S. Steel and Nippon, which carved out specific agreements that said, you can't shut down this plant without our approval. So I'm expecting something along the lines of that. I do expect, like MP Materials investment, they will get returns on those investments. I mean, obviously, they're capital returns and any dividends that go in there. But the current administration seems to be following 2 or 3 different playbooks based upon the reaction that they want to get.
Patrick, do you think Intel is heading toward some financial distressing situation, not unlike what we saw during the great financial crisis with automakers, banks, you name it?
Yeah, we're not there yet, but the big if is how much more market share can AMD take from Intel? You have AMD with 70% market share, server market share with the hyperscalers. You see them taking share in client PCs, and those two businesses are the biggest ones. Intel has a brand new platform coming up called Panther Lake. It looks good on paper. I'm hearing good things from their customers, but AMD could throw a price move and take market share, and there would be some risk of that, where they might need that. I think the difference between this and, let's say, the automobile industry with GM and Chrysler and those equity investments is you can tie the success of Intel Foundry, not necessarily Intel product group, back to national security. Other investments that the U.S. government has made, they were an early investor in Palantir through CIA's venture arm In-Q-Tel. So, there is some prior art or prior reasons for the U.S. government to invest in certain companies.
Peter, last word to you on this. As an avid student of the markets, someone who closely tracks S&P 500 earnings, what do you think about the U.S. government taking stakes in high-profile public companies?
Well, this is part of an ongoing trend of industrial policy really shifting into high gear. if you're one of the companies that's being favored, then yeah, I think you can go ahead and buy that as an investor. But the risk, of course, is that these decisions are not going to be made on commercial considerations. They'll be made on political considerations. And that ultimately is not the best thing for the economy, productivity growth, and the like. And I would also add that, I'm old enough to remember the term Wintel when Microsoft and Intel kind of had this supposed monopoly. Microsoft still does, but Intel doesn't. I think that's kind of a warning for investors that companies like NVIDIA, they're hot now. They may not be hot in like 10 years. We just don't know.
Peter, don't sell yourself short, man. You're still a young guy to me. All right, it's time now for my question of the day. The C-suite just gets wealthier, as is often the case. Compensation for S&P 500 CEOs rose 7.7% last year, according to new data from pay consultancy Farian Advisors. Median total pay tallied $19 million. Wow. So my question is this: why are CEOs becoming even more overpaid, and are they worth it? Patrick, over to you, because a lot of the CEOs in here are big tech CEOs. Are big tech CEOs deserving of this very, very high compensation? Is their job that important?
Well, I think they deserve it if they're driving returns for shareholders. And that's what, the data misses, which is most of their compensation is tied to increase in the stock price, right? Their salaries are reasonable, right? In the millions, maybe even less, but they're really all tied to appreciation. So yes, I think they are deserved of that. And if and when the market starts going down, they will make less money.
Brooke, a lot of these names are also, a lot of these CEOs also in the retail space. I suspect you and I will eventually be on a list like this.
I mean, fingers crossed, certainly. But what we have heard is a Starbucks CEO, for example, his paycheck, Brian Nickel there, about 94% from what I know is his pay comes from stock rewards that are tied to the company's performance. And ultimately, this is something that many companies' board of directors have been leaning into, this idea that if the company does well, so will the executives do well here. And what we've seen is it certainly play out. I mean, Starbucks is in that midst of a turnaround strategy here. We also know that other retail giants that have performed well also have compensated their executives well. And so certainly we're in this environment where board of directors are certainly leaning into this idea because they ultimately want to make investors happy, especially at these record high stock performance that we've been seeing.
Peter, how do you assess a CEO and their impact on a business?
Well, it's interesting to compare, say, Jeff Bezos, who I think annual salary was like $80,000 a year at Amazon.
He really took one for the team, Peter. He really
never got any shares. Like he owns a big chunk of Amazon, but he never got any additional shares from the board. And you contrast that with another CEO. I won't tell you his name. I'll just say his first name is Elon. I won't tell you the last name. Who has had the board just issue tons and tons of shares to him. I don't know. I like Bezos' model a bit more. Amazon was a successful company without the board having to issue him a lot of additional shares. I think other companies can look to that.
There's no last name needed. It's just Elon. A big thank you to Peter Berezin, Patrick Moorhead, and Brooke DePalma. Appreciate it. All right, my forward-looking thought of the day before you head off and trade a lot. A company raises capital for any number of reasons. One, it needs money to fund its future ambitions. Or two, it's worried about its future. Be wary of those struggling companies raising large sums of money because of fears on their future. The latest example is Intel. Usually these are companies so desperate to send positive signals to the market and protect their own butts that terms of any capital raise aren't great for the average shareholder. Coming up, Julie Hyman has you for Market Catalyst. Don't go anywhere.